For our project, we did the duplex project, and we compared a duplex to an apartment around the same area block to get like accurate price ranges and to be able to compare them. So to give you an idea of where our duplex is located, it is going to be in closer to downtown San Antonio. It is actually 14 minutes from the downtown campus. Now, we are targeting the students that go to downtown campus, which is going to be the College of Architecture, the College of Health, and the College of Education. Now, to give you a little more insight on our duplex, there's a picture right here on the right. It is going to be a 2 deep car garage. Each side is about 14 square feet, with each one having its own bedroom and own bathroom. There's going to be 3 bedrooms, 3 bath. And like I said, it's a 2-car deep garage. Also, it was built in 2021, so it is very modern and new, which gives us a little more of an upper hand. And I'll show you all the prices and stuff in the assumption. So here we're going to be talking about like our vacancy rate, inflation, the rent compared with other apartments, as well as our appreciation rate, other expenses such as our the maintenance, utilities, taxes involved, as well as our rent and the cost of the duplex. So for our vacancy rate, our base case is going to be the 7.7% compared to our best case, which is 5%, and our worst case being 10%. For inflation, we did the 2.4%. We went down with our best case at 2% and up with our worst case at 5%. So when we did our research, we realized that the average apartment cost for a 3-bedroom, since we're having a 3-bedroom duplex, is going to be $2,000 a month, which seems relatively high, but you have to put into consideration that it is on the downtown side of UTSA. Our appreciation rate is going to be 3% for our base case, 5.46% for our best, and -1% for our worst case. Now, our rent income is going to be $2,120 for our base case, which is going to be across the board. Now, for our so that's going to be our expenses. I'm sorry. Now, for our income, we're going to have $2,491.10 for our base case. Now, our best case, we went up and did $2,565, and a lot lower for our worst case being $2,430. Now, the cost of our duplex was $600,000 that we would have paid, and for we're going to have the 5-year cutoff, and our WAC being 8.7%. Now, down below, we do have some of the operating expenses listed out for you, how much we would expect to pay, with all of our sources located on the right side for all of our variables. Now I'm going to hand it over to Matthew, who's going to talk about the intangibles and give you more of a base case summary.
Okay, so for some of our intangibles here, you could summarize them based off of monetary costs, but for our purposes, I'm going to focus more on the time and stress costs that would relate to bad tenants, getting late rent, our tenant vacancies and trying to fill those vacancies, parking complaints given the limited parking in the area, finding the tenants, and possible natural disasters that could affect this project immensely. Moving on to our base case. You can see here our first and last rows appear a little bit different than the others, and that's because we separated out buying the house of one lump sum, the $600,000 we said before, and selling the house here after accounting for our appreciation rate. Moving on to our inflation rate, this is going to be the one we talked about in our assumptions. It's going to remain constant through all years, given that it is already a historical average. Then we have our rent costs of other apartments in the area. As we mentioned before, the area starts at $2,000 for a 3-bedroom apartment, and it's going to go up each year with inflation. We also have our rent income in the next column, and this is going to be coming from our total rent charged of $2,800, which is $900 per room, minus the vacancy rate multiplied by 12, as we're counting for yearly calculations here. And then moving on to our total saved. For this one, we're simply adding the rent costs of other apartments that we would have paid otherwise, adding it to our expected rent income, and subtracting the other costs. Then for our value of the duplex, this is going to be increasing yearly, as I mentioned, with our appreciation rate, but it does not account into our calculations until, of course, we sell the house. Now, for our other costs, this is accounting for the total of the costs discussed in our assumptions and also increases each year with the inflation rate. For our net cash flow, it's going to be the same as our rent income. Our cumulative net present value starts for a down payment of $600,000 and is going to increase each year. And that's going to be due to the total saved. Then we also have our incremental net present value, which is going to be decreasing each year. As you can see, these numbers are getting lower and lower each year. And that's actually going to be because of the very high inflation rate, which is going to begin to catch up with the lower appreciation rate of our home value here. Then for the percent of year used, you'll notice that each year it says 1. So we're using the entire year for each of these. The percent of year used, our discounted payback, is actually going to be irrelevant to this project. And the reason for that is that our net present value is never going to go above 0 in a reasonable amount of time until we actually sell the duplex. Moving on, at the end of the 5 years, we sell the duplex and it's increased to a value of $695,000. Sell it off, and then we get a final net present value of actually negative $20,000. And given that this is below 0, we're going to reject the project. Our internal rate of return is going to be below our weighted average cost of capital. So this is another reason why we're going to reject this project. And then, of course, even though the discounted payback period is accepting here, as I discussed before, this is irrelevant to this project. Now we're going to move on to our base case.
As mentioned previously, our columns regarding our down payment will remain constant. Therefore, our cases will consist of placing a down payment for our property, resulting in a negative cash flow for our first year. Now let's take a look at our inflation rate. For our best case, we adjusted the inflation rate to 2%. And as mentioned in our base case, this rate will remain constant throughout the time frame of this project. Moving on to the rent costs of other apartments. As for the rent costs of other apartments, we use the same initial amount present as presented in the first year. Then we altered the cost of each year by the previous year, multiplying that value by the inflation rate. Essentially, the purpose of this column will help us calculate what we have saved yearly. Regarding our rent income, we formulated our results by multiplying the rent generated per room by our vacancy rate, which is present in our assumptions page. Ultimately, in this case, we are assuming that we will be renting our unit out by taking the rent of 3 rooms and multiplying that by our 5% vacancy rate, which would equate to $2,565. We would then multiply that number by 12 months, then adjust each of the following years by the inflation rate. As for the value of our duplex, we kept the initial value of the property the same, but we altered each year by a constant appreciation rate. Ultimately, we raised the value of the duplex by taking the previous year and multiplying that amount by our 5.46 appreciation rate. For instance, we calculated the value of the second year by taking the value of the first year and multiplying that number by our vacancy rate. When comparing this column with our base case, we could see a difference of around $87,000 at year 5, meaning this case provides a higher property value, which will be beneficial when we decide to sell the duplex. Lastly, we calculated what we saved each year by adding the rent costs of other apartments to our rent income and subtracting that from our other costs. Once we acquired this amount, we multiplied it by 12 months, meaning this would be what we would have saved in 1 year. Now moving on to our other costs. As for our down payment, as mentioned before, this is the amount of our initial investment to acquire the home. With that mentioned, we left our other costs for the first year the same and adjusted each year by taking the previous year and multiplying that by the inflation rate. Moving on to our net cash flow, here our numbers are directly related to our down payment and total saved columns. Therefore, since we invested $600,000 in the first 3 months of our project, our net cash flow would amount to negative $600,000, as opposed to our second year where we acquired $29,340. Since we paid the mortgage in full, our net cash flow would only relate to our rent income. At year 5, we account for selling our property, which will affect our cumulative MPV. Next, let's take a look at our cumulative MPV. Since we invested $600,000 in the first year of this project, our MPV is at a negative 600,000. But as we begin renting our other unit, we slowly make progress each year and our MPV slowly increases. However, since we did not plan to own this property longer than 5 years, our cumulative MPV turns positive in year 5 as we sell the duplex for $782,000. Lastly, our incremental MPV will decrease as our net cash flow increases. As mentioned before, the percent of year used is irrelevant to this project as we will sell the property at 5 years. Lastly, let's take a look at our MPV, internal rate of return, and discounted payback. We then calculated our net present value of our best case and determined this venture would be acceptable. After our calculations, we remain with a positive $40,000, and that would mean we would gain financially as opposed to the base case where we are losing $20,000. From this perspective, this venture would be acceptable. The internal rate of return for this project would be deemed as acceptable since our IRR is greater than our WACC. Overall, if we pursue this venture, we would make a return on our investment. Though discounted payback says that this project is acceptable, as mentioned before, this value is irrelevant to our project as we are selling our property at 5 years. Now let's take a look at our worst case. Just as before, the first year of each case will be identical, which illustrates our investment towards this duplex. Now looking towards our inflation rate, for this case, we adjusted our inflation rate to 5%, which remains constant throughout the entire scenario. Moving on to the rent costs of other apartments. As for the rent costs of other apartments, we use the same initial amounts present in the first year. Then we alter the cost of each year by the previous year, multiplying that by the inflation rate. When comparing this column between the worst case and the best case, it would seem that the worst case may be a promising venture as their values are higher, which would be beneficial to our total saved column, but we will later debunk this idea as we continue through the presentation. With that stated, let us take a look at our rent income. Once again, we formulated our income by multiplying the rent generated per room by our vacancy rate, which both values are present in our assumption page. Ultimately, in this case, we are assuming that we will be renting our unit by taking the 3 rooms, the rents of 3 rooms, and multiplying that by our 10% vacancy rate, which would equate to $2,430. We then multiply that number by 12 months, then adjusted the following years by the inflation rate. And now let's cover the calculations of the value of the duplex. As before, the initial value of the duplex was $600,000, which was the amount we purchased the property for. But if we look closer at the following years, we can tell that the value of the duplex seems to be decreasing each year. This effect would be due to the negative appreciation rate, which can be justified as vacancy rates are inversely affected by the appreciation rates and vice versa. Ultimately, the value of our duplex drops around $30,000 in year 5. These results will later prove why this is our worst case scenario. Moving on to our total saved. Lastly, we calculate our yearly savings by adding the respective rent costs of other apartments to our rent income, then subtracting our other costs from that calculation. We then repeat this process until we reach year 5. Since we already understand the output of the down payment column, let's move on to the other costs. We calculated our other costs by obtaining the monthly expense of utilities, taxes, insurance, and maintenance, eventually multiplying that number by 12 months to get our yearly costs. After that, we adjusted the second year by the inflation rate. Next, moving on to the next net cash flow. Our numbers are directly related to our down payment as previously mentioned. And after the first year, since we got our down payment out of the way, we would only be focusing on our rent, our total saved. Moving on to our cumulative MPV, we will, since we invested $600,000 in the first year, we would have a negative $600,000 for our cumulative MPV. But after we begin renting, we slowly make progress. But even though we decide to sell the property, we would still acquire a negative MPV at the end of year 5. As for our incremental NPV, As our net cash flow increases, our incremental NPV decreases once we rent out our unit. As mentioned before, the percent of year used is not relevant to this project. Moving on to our NPV and our IRR and discounted payback. Since our NPV is negative, we would reject this scenario. This would also go for our IRR since it is lower than our WACC. Now we can move on to the break-even analysis. Moving on to Jess.
Okay, so assuming all the numbers from the base case, the rent is $2,393.85. So as we have looked at all three of the cases, we can see that the base case is not that far off from the best case because we can see that the total saved in the break even is only $1,000 or so off from the best case. We can also see that we are taking a huge cutback on rent income yearly by about 10 to 15,000 from the best case, which already seems, of course, like we should reject this case because we're generating way lower income. Next, we are looking at the net cash flow, and we can see that we are generating more than 100,000 less than the best case, which of course proves my previous statement as well. Also looking at the cumulative NPV, we see that it has zeroed out because this is our break-even case, means we are not generating any income. Any extra net present values as far as a cumulative standard. And we can also see that in incremental NPV, we can tell that we have made more than 100,000 less in this case than in the best case, which continues to provide us with substantial information about rejecting this case entirely because we are not generating enough to keep the property. As far as the net present value, it's zeroed out, and our I can't see it. The internal rate of return is 4% about. We reject it because it is less than WACC as well. And so looking at the summary chart, we are basically summarizing all of our findings, which gives us the net present value, the IRR, and discount payback. Discount payback, of course, is nullified in this project, but we can tell that we are for sure rejecting the base case and the worst case, and of course, the break-even case, because we are rejecting negative values as well as values that are less than the WACC. The only case that we really benefit from is the best case here.
In conclusion, we're just going to recommend that we reject this project and rent an apartment instead of buying a duplex.
All right, good. I do have a couple questions for y'all. So you used a pretty high WACC. So obviously if you used a 5% WACC, you would have gotten positive net present values. Did y'all discuss how you got that 8.7 WACC? Was that something y'all came up with, or you just pick it?
The reasoning for that was mainly just because of how crazy house prices are in today's market. But apart from that, we didn't do any complex calculations by that number.
Yeah, I mean, it's and this is where the beauty of a net present value is mortgage rates are up. So your WACC probably is getting much higher. If you'd done the mortgage, your mortgage payments would have been much higher too. So it kind of offsets it. That's why you don't have to do the mortgage. So in your case, you're right in the middle of the WACC decision is pretty important because mortgage rates are 150 basis points higher than they were just a couple of years ago. And has a huge impact. Housing prices are up too, but you're buying a house. So, you got this big risk of you might be at the top of the market. So I agree there's some danger there. But it definitely would have made sense at a 5%. 5% is probably too low because mortgage rates are probably above 5%. So yeah, I agree. You probably needed a higher number for this. I'm not quite following your inflation numbers because it sure seems like your worst case would be better at 2%, and your best case would be worse at 2%, and your best case would be better at 5%. So I don't know. I mean, look at your best case. What's your best case net present value? 40. And now change your inflation to 5% and see what happens, because I think it's going to go up. If I'm understanding this is me understanding your spreadsheet kind of analysis.
Yeah.
So I would switch those. I think your inflation hurts your expenses, but also increases your benefits. And the reason I think the higher is better because your net cash flow goes up exactly by that inflation.
Okay.
So, I would think 5 and 2 makes more sense than 2 and 5. Yeah, and on your intangibles, I agree the intangibles. So those are all horrible things. You can solve most of those, if not all of them, by hiring a property manager, which your base case doesn't support. Do y'all know how much a property manager would cost?
No, we didn't do research into that. We were just assuming that since we're college kids, we would attempt to do that ourselves.
Yeah, so that could be a real, it's either going to be a piece of cake or a nightmare, depending. You're talking about releasing out the college students, and no offense, but that can be a disaster in some cases because they're not necessarily the most empathetic roommates. Is this the type of project where you would need to do a lot more research and look at 6 or 7 different properties, or is this probably just doesn't make sense right now because housing prices are so high?
I would say that it just doesn't make sense right now because of the market, especially in San Antonio. I think we discussed it before. It's not just Austin that's insane. San Antonio is blowing up as well when it comes to the housing market.
Yeah, I agree. Yeah, if you'd done this, I think this is something that 3 years ago when mortgage rates were below 4 and housing prices were 30% lower, that would probably be enough because your WAC would have come down probably 100 basis points and your property costs would probably come down and your appreciation could probably be higher because, property prices and so yeah, this is kind of you enter at your own risk in certain markets. You prefer to do this in a market that isn't at a 30% rise over previous year. All right, good case. Send me your final Excel. I wish y'all had run the scenarios on the break even. I do think that works in this case. It just, I just think there's more moving parts. You got another one with the inflation, and I think you have so many moving parts here. If you really want to help someone make the decision, I think you've got to be a little bit dynamic. It's tough though. You've got to somehow figure it out. I would probably do some work and try to figure out appreciation versus, actually look at some markets and look at appreciation versus vacancy versus I don't know, inflation and rents and those kind of things. Because this is a pretty big decision, $600,000. Obviously, you're going to borrow a lot of it, but still, that's even worse. It doesn't work out because then you got a major mortgage you got to pay off at the end. So, all right, good. I wish y'all had some people reviewing it. I'll put the recording out there in case someone wants to watch you and give you feedback. So, all right, thanks.